Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of Canadian Investing in the U.S. with Glen Sutherland. This week I got Marcin Drozdz, repeat guest, episode 172, episode 251. So like to have him on every few years. Yeah, basically every few years. We're at I'm just looking behind me, 370 we just released. So yeah,
Wow, you're 370?
yeah, once a week. It's what were we at, 7 years of this, once a week. So it keeps adding up.
You should do like a montage of like your face over 7 years to see like how much better looking you are today compared to like 7 years ago. I think it'd be pretty
Jeez.
cool.
I don't know if that's better, but you know what? I bet you I could easily do that too, right? I got all the
Mhm.
pictures anyway. Um, yeah, I was going to say something, I forgot what it was. But anyway, Marcin, for people who don't know who you are, which I think most people who listen to this have seen you before, give us a bit of an intro, and we'll go from there.
Yeah, sure. Good to be here, obviously. Sounds like this is the third time I'm doing it, so that's cool. Glenn, you and I have known each other for a few years now. For those of you who haven't met me before, I've been in the private equity real estate space for about 20 plus years now, raised multiple nine figures in private capital, real estate operating businesses, development projects, did some tech years ago as well. So done all kinds of different things in the capital raising side. And yeah, really enjoy teaching that, enjoy doing it, obviously, and just watching Glenn with the obviously Canadian investing in the US. I am a Canadian also investing in the US. Most of what I do now is in the US. We do have some portfolios here in Canada, but by and large, we're US based. We buy value add distressed properties, and yeah, it's a really good time to really be in this business right now. So.
Yeah, I've been reading a lot of different things about different opportunities and market cycles and some stuff that's predicted to change near the end of the summer. So maybe we'll sort of go down that path since we sort of brought it up. But like when you're underwriting these sort of projects now, it's a different thing. It's a different beast to even underwrite these. Like just the way um, when you want to go present one of these projects, like when we're talking, maybe I should backtrack a little bit. We're talking about like underwriting like a syndication or a larger multifamily project. Where a lot of times you make your money on like rent growth, you'd make your money on value add, and is that the same thing? Are you still using the same strategy? Does rent growth still play into your underwriting the way it used to?
Well, I mean, no. And, my favorite saying in real estate is you always make your money when you buy, you just get paid when you sell or when you refi, right? So
Yeah.
I'll give an example because we were talking about this. So for context, 2 years ago, just shy of 2 years ago, I bought a 144 unit down in Houston, Texas. And at the time, the cap rates for a comparable asset were 5.5, 5.75. And for those of you who don't really understand cap rates, the higher the cap rate, the lower the value, the lower the cap rate, the higher the value. So the cap rates were in the mid fives for that kind of asset that I was buying. And when I underwrote it, I didn't underwrite it at a 5.5. I underwrote it in the mid sixes. And the reason why I did that is because I anticipated that the future was going to be more bearish than the past, which is exactly what has played out. And long story short, the seller wanted 16, I paid 11, partly because of how I valued it, how I underwrote it, and how I was able to negotiate the deal. So, fast forward to today, the cap rates are higher than they were when I bought it. So in other words, the valuations technically went down, but because I had built that into my pro forma when I bought the asset, literally, I was just telling you this. We just got the appraisal back on the asset. It's about $18 million. So paid 11, it's now worth 18. So in a declining market, I added value. And how we did that was not through hoping for rent, not for hoping for rent growth, not hoping for appreciation, but forced value, forced appreciation within the asset. And that was the thing that was why we made money on this asset because I wasn't in that modeling, I wasn't saying, hey, we're going to get this rent plus 3% per year. I had built in the fact that there were going to be headwinds coming in. So, yeah, the underwriting today is drastically different than it was during the call it heyday 2 years ago.
Yeah, and it's also something to if you're going to invest, like as an LP, if you're going to invest
Mhm.
in one of these projects, if the majority of how they're going to make this property appreciate is through rent growth, that could be a red flag.
That's a major red flag. I mean, listen, it's like so there's and we can talk about this. Like I have one of my mentors, Ken McRoy, he's MC companies at 2 billion in assets. And when they buy assets right now, they're factoring in no rent growth for the next, I think, 24 months on some of these assets, depending on where. And that should be very telling because he's got over 10,000 doors across the southwest there. And if he's not writing in rent growth, I mean, I'm not doing it.
Yeah. And like another part that people make money on is like, a lot of they say the differential between the interest rates and what the cap rate is there's a what do you call that? There's a
Yeah, the
space
spread there.
in the
Yeah.
spread. Um, is is this it's got to be a lot harder to do that right now with the higher interest rates. Are you looking to invest in the US? Are you looking for a coach rather than a coaching program? Well, you're in luck because that's where my coaching program is completely different. It's not about just teaching you all the material. It's about like having a community of people all doing the same thing. It's about doing one-on-one calls with me to strategize, to plan, to look over deal analysis, to check markets with you. Just honestly, just to solve mistakes before they happen. If that's interest to you, you want to learn about the coaching program, or you just want to do a one-on-one call with me just for like 10 minutes, just to answer a couple questions, just to get to know me, go to my website, glensutherland.com, or at canadianinvestingintheusa.com, and you can book a call right at the top. And I'd love to get on the phone with you and just even get to know everyone.
Yeah, and that's why the private equity guys, like the traditional private equity guys, are really not liking real estate right now because they don't, everybody says they want to be a value investor, but what they really want is they just want the arbitrary pickup without actually having to do anything for it. So I'll give you some context. When rates used to be 3% and cap rates were 6, you could pick up a 300 bips spread just by being in the right place at the right time and literally just ride the market. Today, well, as an example, the asset that we're refining right now, the rate, I mean, subject to rate lock and when everything's done, the cap rate is 6.5 and the rate is 5.5. So yeah, there's a spread of 100 bips, but if I bought it just for the purposes of picking up that spread, I mean, there's easier ways to make a living. And I think that's your point, right? So,
Yeah, no, honestly, even just from working in the smaller buildings, the single family, and like I basically left my job on the little stuff, right? And before I went to the big stuff.
mhm.
But um yeah, I make my money on the forced appreciation, right? It's
Yeah.
you plan for that, and even if the ARV isn't what you think, like whenever you're doing like residential, you're still not going to lose money, right? Because you've forced this up, and you're going to compare against better stuff, right? So that it's the same sort of thing. And you look like you're going to say something.
Well, I'm just thinking about it like, yeah, practically, like, so that using that property as the example going forward. So the one bedrooms were rented at 695 or 725, depending on the layout. And now fully renovated, furnished, everything, not furnished, pardon me, fully renovated, cleaned up property. I think our ones are 975 to 1050. So, that's forced appreciation and that's at market within the area.
Yeah, so you're not just relying on the rent to go up on its own. You're adding,
No.
I'm guessing washers and dryers and community areas and stuff like that. Am I on the right
Oh
track there?
yeah, yeah. Well, and then that's extra on top of that because when I say the rents have gone up about $300, that's just the base rents. Plus, we've recovered on trash collection. We've recovered on water. We've also to a third of the units they had washer dryer hookups. So I think we're charging either 55 or $75 per unit per washer dryer. We did covered parking. We because in Texas it's like if you leave anything on the dashboard throughout the course of the day in the sun, whatever that is, she's gone. It's going to melt. So that covered parking, that extra 25 or $30 per stall, people happily pay for that. I think we have a lineup for those. So yeah, all those little things combined, and yeah, you end up picking up, you pick up the pennies and the dollars take care of themselves.
Yeah. No, I totally agree. I was just down in well, I guess not just. I was down in Texas in August, and it was hot.
That's
It
the
was so
best.
hot.
I read, Glenn, I don't know if I told you this, but living up in Canada, we're so deprived with summer. So I was down in Texas, I think it was in May or whatever it was, and it was still crummy, not this year, the previous year. And I rented a convertible and I forgot I was in Texas. So I drove out of the airport and I'm like, this was a bad decision because it's just like instant heat.
And you're like, I want the air conditioning. So
Yeah,
off the
then you
top,
try
like,
to
what's the
turn the
point?
AC on.
Yeah.
Yeah.
So I don't know if you're doing a raise right now, but have you had like a lot of pushback? I know a lot of Canadians are a little shy about the US right now. There's a
Yeah,
lot of
you know what's interesting is before Trump introduced his let's just say new philosophy on how global trade is going to work,
yeah,
I was at the time seriously in the middle of launching a new fund for Canadians to invest in the US. I have put that fund on hold for the time being, not because I don't believe in the US thesis. I love the US thesis, but accredited investors don't need the fund, so they can still co-invest, but it'll be more of a direct type of a thing. And we've really doubled down on the US marketplace. So we have multiple things that we can't discuss it yet, but we have multiple projects that we're going to be launching in the US with US investors. And we do have Canadians that are going to be able to co-invest, but they're going to have to come in as accredited because the retail side in Canada right now, there is a stigma towards the US. My high net worth clients and friends and people that are, generally business people, they're not worried about it, but for the retail everyday investor, yeah, there is a stigma to the US right now. And, I don't want to I don't want to go against the grain with the retail investor.
yeah. And I guess if you already have the connections with American investors, then it's it isn't necessary to go down that path then either, right? Have you been thinking about investing in the US, but wondering if these numbers actually pencil out? So I created a deal analyzer exactly for that reason. So if you're interested in it, completely free, go to CanadianInvestingIntheusa.com/deal.
Yeah, well, I mean, you can do both, but the challenge is my point is we were thinking of doing a retail offering in Canada, RSP eligible, TFSA, eligible investor, all that stuff. But then when the whole thing happened with Trump, the retail investor is the person that's going to be the person that reads those headlines, and they're more likely to be the person that has the issues with those headlines. Me and people like yourself and accredited investors, we kind of separate the sensationalism from the actual heart of the matter. And hopefully everybody kisses and makes up, and maybe we don't have to have this conversation anymore. But until then, I'm just going to stick to what's easy.
So in the meantime, where you're in these kind of spots right now, um, are you still communicating with all these investors? And if so, like how are you doing that?
Yeah, I mean, my whole philosophy is you got to dig your well before you're thirsty. So what does that mean? I mean, if you're starting to have a conversation with investors when you need the money, you've already lost. Like because it's a priority for you doesn't mean that that person that you're starting a conversation cares or even has had the mental time to consider the thing that you're saying. Like think about the process you go through or I go through, Glenn, when we're analyzing a deal or a fund or a business or opportunity, we go through a whole process. And you've mentally kind of sold yourself, hopefully you've sold yourself out of it, into it, and you've gone through the whole process. And then when you finally come out on the other end, you feel confident. Well, your confidence is not going to immediately translate with a person on that first conversation. So the whole point is just like yourself with your podcast or an email list or having some kind of community, having a way to pour into the people and teach and add value over an extended period of time. When it finally comes time to doing a deal, they're already sold on working with you. They understand what you're all about. They understand how you do things, who you are as a person, your values, your beliefs. And then it's like, okay, I'm bought into all this. Do you like this thing? Yes. Okay, great. Like, let's go. And the deal is actually secondary. You, as you very well know, you are the reason why they're even going to look at the deal in the first place.
Yeah. No, there's tons of syndicators. There's tons of people looking for joint ventures for different ways, private lending. There's all kinds of people looking for this. So it's about
Yeah.
finding your niche, I guess, right?
Well, there's no shortage of, I call it credit in the marketplace, but there is a drastic shortage of credibility. So, in other words, there's a lot of people with credit, cash, but there's very few people with the credibility and the trust built up with the people to just bring these together quickly.
Yeah. If if you were going to give like someone, I know you have students as well, and you're going to give them a recommendation to try and build some credibility, could they do that?
Well, I mean, it depends on where you're starting from, because if you're starting from zero, then the most powerful thing you can do is get in the room with people that are already doing stuff and just ride their coattails, get involved, add value. I mean, it goes back to the story of some of the decisions you and I have made earlier on in our career, right? I mean, I got into real estate by carrying for sale signs for real estate agents when I was a kid because that was how I could get into the game. I couldn't add any value any other way. And then I ended up working at a PE firm and there were things in between. And, I never really cared what I made at that point in my life. I just wanted access to the people, to the deals, to the rooms, to the environments. Now, if you're sitting there and you're in your 30s and 40s and you've got mortgages and bills to pay, then obviously you're going to operate differently. But then perhaps you take some of your savings and become an investor in someone else's deal. Maybe you take the time to volunteer, to get involved, to do some due diligence. Like you find ways to hook your wagon up to somebody who's, call it 3 to 5 years ahead of you,
Right.
and work backwards from there. And if you want to expedite your process beyond that, consider mentorship programs, whether working with you or me or someone else or somebody you can, because what you're really doing with those mentorship programs is you're buying your time back. That's what it is. Because what you've learned over 10 or 15 years, or what I've learned over an equivalent period of time, if I could just give you the Coles notes of that in real time, you're going to save yourself the tire spinning for the 3 to 5 years.
I couldn't agree more. The hardest thing is whenever I have someone join the program later on and they've made a whole bunch
Mhm.
of mistakes and they're hoping you can fix them. That's
Yeah. Glenn, I spend a lot of money on myself with personal development, and I call it personal development because that's really what it is. A lot of
yeah,
it is consulting and corporate and whatever it is, but I, I just signed up for another one. It was 45 grand. Like I just, it's like and by the way, it's all relative to where you're at. $400 could be a lot, but the art of investing in yourself, as long as you value what's in here more than those trips or watches or crap like that. And as long as you're spending money on knowing that if you're going to spend $500 or 5,000 or $50,000 on a program, that is an investment in yourself because you believe in yourself that you're going to get a return on that because of whatever else it empowers you to do. That's the wealthy mentality. That's to me, I never hesitate to buy a book, to buy a training, to buy a mastermind. Because I always know I'm going to get something that fits into my journey.
oh yeah, no. Every time I do it too, sometimes it's even you go to a conference and the whole time you sit there, but maybe you meet somebody, maybe make a connection, maybe you get one little thing that even is something I already knew, but I kind of
Yeah.
forgot about or I haven't been doing.
Yeah.
I haven't been doing it, and I
Yeah,
just need to go get
yeah,
my
that's
butt.
so true. That's it's not even that you need to be taught. Sometimes you just need to be reminded, right?
Yeah.
So, and I have a beautiful wife for that. She reminds me of things that I seem to forget all the time. So,
That's great. Before I let you go, I'm going to also put you right on the spot here. So if you're not ready for it, that's okay too. But LPs, people investing in these sort of projects, we briefly talked on some red flags before. If you wanted to give anyone, like, if they're looking to invest, anything that they should be asking a syndicator, anything that they should be looking for, or something that's a red flag, just to give them some people some advice for doing for investing.
so there's the standard answers that everybody will give you, like make sure that they've got some skin in the game, figure out what the fees are, how things are aligned, and all that's great. But I think a really interesting question to ask a syndicator is where they perceive the risk in the deal. So
Ooh.
ask them where they perceive the risk to be in the deal. Ask them to tell you what would need to happen, what are the things that would need to happen for this to be a bad deal. And the reason why I like that question, I ask it for potential partners, I ask operating businesses on whatever it is that I'm in the middle of. And the reason for it is because I want to see what your level of awareness is in the deal. Because, I like confidence in an operator and in a partner, but I don't like blind confidence. So if you have no awareness over what the things are, like a great answer is, hey, so here's how we could potentially get in trouble with this deal. Boom, 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 because of these things. I'm waiting for this. I do this, zoning, quote, insurance, whatever. Here are the issues. But here's how we're mitigating that. And having somebody be able to tell you where the risks are because they're cognizant of them, and then also show you that they've thought of that and how to resolve that. That to me is a really good indicator of the kind of operator you're dealing with because the worst kind of answer you're going to get is the typical salesman. Oh, don't worry about it. Real estate always goes up. You're going to be fine. we've never had a bad deal. Like as soon as you get shallow answers like that, I run for the hills because it shows me that you either don't know or you're like you're oblivious to it. Like you can't have the world one way. Like you need to be aware of the fact that there is risk. So how do you identify and how have you mitigated it?
I love that answer. That was great. Thank you, Marcin. Before I let you go, if people wanted to get a hold of you, if people wanted to hear about M1, if people wanted to hear about what Marcin Drozdz is buying next, where do they find you?
Sure. Yeah. My website, marcindrozdz.com, MarcinDrozdz.com. Go there. There's tons of free resources there. And yeah, we're in the middle of a transformation here in 2025 when we're recording this. There's a debt wall hitting in the United States on the commercial side. If you don't know what that is, look it up. There's over $1 trillion in debt maturing right now. A lot of guys I talk to on the bank side are lenders are pretending and extending and there's so many deals. My partner just literally is closing on a 3 unit, 140 unit, $1 million portfolio today. So there's and it's a bank REO or real estate owned. So there's a lot of opportunity there, and now is a really good time to become either a more sophisticated passive investor or an active investor like Glen on that.
I love it. Well, Marcin, thank you for coming on the show, like always.
Yeah, you got it. Look forward to it.
That was a nice video. Bye.